Global alert. Japan has unleashed a financial earthquake that no one in Washington imagined. This historic U.S. ally has caused the biggest economic shock of the year by selling U.S. Treasury bonds worth $119 billion, triggering a $17 trillion drop in global markets in just 3 days. While President Trump publicly downplays the severity, his team is rushing to the White House trying to stop what many experts call the beginning of the dollar's decline. What is really happening? Why is Japan, the world's fourth-largest economy, abandoning the dollar at such a critical moment for the global economy? The most alarming aspect is that this marks the silent collapse of U.S. financial dominance, and not by a minor player. For years, Japan was the largest foreign buyer of U.S. debt, acquiring bonds with Swiss watch regularity. But in January 2025, that story changed. Official data shows Japan drastically reduced its bond holdings, recording the largest quarterly sale since 2012. Ironically, China is now the largest foreign holder of this debt. Although the Bank of Japan justified this move as a technical adjustment, specialists like Frederick Nanman from HSBC say it is a strategy to protect against growing U.S. fiscal instability. This was not an impulsive reaction. Japan had been sending clear signals for months, from its frustration with Trump's aggressive trade policies to the dollar's volatility. In November 2024, the U.S. imposed a 25% tariff on Japanese electric vehicles, citing national security threats and unfair subsidy practices. Tokyo's response was immediate and forceful. The Ministry of Economy labeled the measure as disproportionate and economically unfounded, while Nissan's CEO warned it punishes innovation and fragments already consolidated global supply chains. But the blow did not come from the automotive industry. It came from the financial markets, where Japan sent a clear message. If the U.S. wants a trade war, Japan will respond with its finances. And Japan is not alone. Central banks of countries, like South Korea and the United Arab Emirates, have also started reducing their dollar reserves. In just 2 weeks, the dollar index fell 21%, and the 10-year Treasury yield rose to levels not seen since 2007. This financial panic is not an isolated accident, but the result of an increasingly unpredictable protectionist strategy led by Trump, whose administration seems more interested in provoking crises than strengthening alliances. After the tariffs on electric vehicles, another factor intensified the tension: Toyota's unprecedented technological advance. The Japanese automaker introduced a solid-state battery capable of delivering 750 miles of range with just 10 minutes of charging, leaving behind the U.S. industry, which still relies on lithium-ion batteries and limited graphite supplies, many controlled through Chinese restrictions. Toyota and Panasonic have already launched a platform for electric vehicles with this technology, with a massive rollout planned for 2026 and pre-orders from Europe even before its launch. The message is clear. Japan has ceased to be just a supplier and is now an actor with real negotiating power, and it is demonstrating it. According to the Wall Street Journal, Japanese diplomats and business leaders now demand tariff exemptions in exchange for strategic technological alliances, making it clear that leadership in batteries has shifted from merely an industrial issue to a crucial geopolitical asset. Meanwhile, Japan's withdrawal from the U.S. bond market has had a devastating effect. The Congressional Budget Office warned that this change will increase the cost of public debt by $270 billion annually by 2027, worsening a deficit that already reached nearly $2 trillion in fiscal year 2024. Amid these warning signs, the market suffers, interest rates rise, credit becomes more expensive, and American families face higher costs on mortgages and credit cards. Tiffany Wilding, PIMCO's chief economist, told Bloomberg that losing stable buyers like Japan increases Treasury bond volatility and weakens global confidence in U.S. fiscal stability. The most alarming data came in March 2025 when the Federal Reserve and Treasury Department confirmed that 13 central banks, including those of Brazil, Egypt, Indonesia, and Saudi Arabia, have started conducting bilateral transactions in local currencies, completely bypassing the dollar, which represented more than 61% of international reserves in 2020, has fallen to 54%, according to the International Monetary Fund's March 2025 report, and this trend appears irreversible. China's interbank system, SIPS, already processes over $447 billion in non-dollar transactions, while BriCPay, a platform backed by India, Russia, and South Africa, is preparing for its official launch in July this year. In this new scenario, a U.S. monetary supremacy is not collapsing in a single blow, but through thousands of silent cuts. As the dollar loses ground in international markets, President Trump seems determined to intensify global economic chaos. In February 2025, his administration announced a new round of punitive tariffs, this time aimed at Japanese electronics and South Korean semiconductors, sparking alerts about a possible large-scale trade war in Asia. BlackRock analysts were blunt. Political uncertainty has become the main trigger of financial risk. Investors are not the only ones noticing. Moody's downgraded its outlook for the U.S. to negative watch, citing out-of-control deficits and unresolved geopolitical tensions. What happened next was even more disturbing. The Trump administration defied a court order. In March 2025, the D.C. Circuit Court temporarily suspended the new tariffs on South Korean exports, arguing there was no justified national security threat. However, Trump, citing Section 232 of the Trade Expansion Act, openly ignored the ruling, unleashing a constitutional crisis. According to the Wall Street Journal, legal experts like Professor Bruce Arian called this a direct challenge to the Constitution, as that law was intended for genuine emergencies, not to protect protectionist strategies. The market reaction was swift. Treasury yields rose 29 basis points in just 24 hours, and foreign investors withdrew more than $21.7 billion from U.S. exchange-traded funds. The message was clear. If even judicial decisions are ignored, the legal stability of the U.S. enters uncertain territory. This situation led Chief Justice John Roberts to make a rare public statement, warning that bypassing judicial checks undermines global confidence in U.S. institutions, a message aimed at both voters and international markets. The World Bank, in its 2025 governance report, recorded that the U.S. fell 5 places in judicial independence rankings, dropping below Canada, Germany, and even Singapore. This institutional deterioration fuels a troubling perception. Not only is the strength of the dollar at stake, but also the structural credibility of the U.S. system. According to Credit Suisse, 5-year U.S. bond default insurance rose 14 basis points overnight. Volatility premiums multiplied, and markets began pricing in systemic risk that until a year ago seemed unthinkable. While Trump insists everything is under control, the reality experienced by major investment funds paints a different picture: an unstable economy, a weakened currency, and alliances starting to fracture. The dollar is no longer the undisputed currency, and time is running against it. Amid this turbulent financial and diplomatic scenario, an unexpected protagonist quietly emerges. Canada. While the White House focused on China, Japan, and the European Union, Ottawa charted its own course, gradually moving away from U.S. economic dependence. In the first quarter of 2025, Canada signed an agreement for digital currency interoperability with the European Central Bank and the Reserve Bank of Australia, seeking to reduce its reliance on the SWIFT system and facilitate direct transactions in digital currencies. According to Reuters, this measure is part of a broader strategy to protect against possible trade reprisals from Washington and diversify its strategic exchange channels. But that was not all. Mark Carney's government accelerated its plan to secure critical minerals, finalizing long-term contracts with Australia and the European Union for lithium and cobalt supplies, vital for the battery industry and clean technologies. Thus, Canada avoided potential restrictions imposed by the U.S. while strengthening its position in the global value chain. The results are already visible. Trade between Canada and the European Union under the ZET Agreement grew 16% year-on-year, while exports to the U.S. declined 34%, according to Statistics Canada. Finance Minister Chrystia Freeland clearly stated in an interview with The Globe and Mail, "Economic resilience today means not relying too much on a single economy, even if it is an ally. Canada is not distancing itself from the U.S. It is simply protecting itself from its instability." This statement caused discomfort in Washington, where the northern neighbor is no longer seen as a mere follower. At the same time, the relationship between Europe and the U.S. is also deteriorating. In January 2025, Trump imposed a 200% tariff on European wines as retaliation for sanctions against U.S. tech companies over privacy violations. France, Italy, and Spain quickly responded with complaints to the WTO and mirror tariffs on U.S. pharmaceuticals, medical devices, and aerospace components. The impact was clear. The trade surplus between the U.S. and the European Union fell by $13.6 billion in 1 month, while Californian exporters saw a 22% drop in wine sales to Europe, according to the U.S. Wine Export Council. Airbus CEO Guillaume Faury warned that an escalation in this conflict could paralyze aerospace supply chains on both continents, putting thousands of high-tech jobs at risk. What began as a tariff whim has transformed into a real threat to the global industry. However, the deepest blow was neither commercial nor financial, but institutional. When a U.S. president openly challenges judicial decisions, imposes tariffs without technical justification, and turns every diplomatic disagreement into an economic war, the world stops seeing the United States as the pillar of the liberal order, and begins to perceive it as an unpredictable and even dangerous actor. The White House may repeat that everything is under control, but the numbers tell a different story. The IMF confirms that the use of the dollar in global reserves fell from 68% in 2020 to 54% in 2025, with a downward trend. Platforms like CIPS in China and BRICS-Pay, which until recently were alternative experiments, now handle hundreds of billions of dollars beyond Washington's reach. As Janet Yellen warned at the Council on Foreign Relations, we are entering a more fragmented monetary era. Dollar dominance will not disappear overnight, but it is no longer unquestionable, and that changes everything. Because when a currency loses trust, not only financial power is lost, but also influence, negotiating capacity, and respect. Today, Japan has sent a signal that cannot be ignored. Its massive bond sale was not simply a technical action, but a silent alarm indicating that the foundations of the global system are in crisis. While Trump maintains his power discourse, the traditional allies of the United States are reorganizing, safeguarding themselves, and preparing for a future where the dollar is no longer the dominant currency. Therefore, the question is no longer whether the economic leadership of the United States is in danger, but who will take the reins and establish the new rules when the dollar loses its influence. Will it be China, Europe, some emerging bloc, or someone else ready to assume that role?